Hi, everybody. Welcome to today's Manage Your Money During Coronavirus webinar, run in conjunction with the NOLA Public Libraries. My name is Alexander Bigby. I am the Executive Director of Flight. We're a New Orleans-based nonprofit that helps provide free financial education resources for communities and individuals around the city. If you'd like to learn more about us, please visit our website at flightcoaching.com and also check us out on Facebook. Today's format will be a presentation with a Q&A afterwards. Should last around maybe 20 minutes for the presentation or so, maybe longer, and then the Q&A around 20 minutes. Usually ends up being around 40 minutes, but that depends on how many questions we have. If you have any questions during the presentation, please type them in the comments section, and then I can ask them after the presentation's over. Also, if you have any just general comments, please add those as well. The video of this presentation will be made available on our website within 24 hours, and the PDF from the presentation will be available too. So without further ado, I will introduce today's speaker. Today we have John Zollinger from Home Bank, who will be talking to us about credit. And I'll let you take it from here, John. Thank you.
All right. Thanks, Alexander. Good morning, folks. This is a somewhat dry topic a little bit, but hopefully we can make it interesting for you guys. At this point, I'm going to share my screen. I have a presentation to do. And Alexander, I think you have to let me do that. Okay, I'm the host now. All right, let's see.
Should be able to share your screen now.
Yeah, there we go. Hold on. Here we go. Okay, so understanding credit, it really is just a presentation about kind of the basics of credit. If you guys have, and this is going to be kind of high level, so if you have real specific questions, be glad to answer them as we kind of go through. So you can either raise your hand or type in the into the comments box. Shoot, hit the wrong button. All right, the first is just a disclaimer. A little bit about Home Bank. We're 112 years old this year. We're a publicly traded bank. We're based in Lafayette, Louisiana, about $2.2 billion in assets. And we've got 12 locations in the greater New Orleans area. Okay, so what is credit? Credit's an arrangement you make with somebody for services or products now in which you pay later. So someone's willing to extend you credit. That's the term. And for that, you generally pay interest, which is, I look at it kind of like rent. You pay to use the apartment that is owned by someone else. So the money is covered by someone else, and you're paying for the use of that money. That's the interest rate. Different types of credit. You have revolving credit. Those are a line of credit or a credit card, and that means that you can go up and down on the loan as much as you want in that period of time. The second is an installment credit. So that's it starts off at the top amount, and you just keep paying it back over time. So you'd have a regular payment amount that you'd pay every month, and at the end of that term, you would not owe any more on that loan. A mortgage credit, that would obviously be on a home. So it's probably the biggest purchase you'll ever make in your life, and we're going to talk a little bit more about that a little bit later. And then service related, so utilities or cell phones or things like that. So if sometimes you buy phones on credit, you pay monthly for your phone inside of your contract with the provider. Okay, so why is credit important? Why would we want to make sure that we have it? The biggest thing here is that it takes a long time to save up money for a big purchase like a house. So if you wanted to buy a house for $90,000, which I don't know, there's not many homes at that price, but there's some, it would take you 90 months if you were able to save $1,000 a month. So this way, if you're able to put 20% down, you only have to save a couple $1,000s to be able to make that purchase, and the bank or another lender will lend you the rest of the money. I look at credit cards as they're a good thing and a bad thing all in the same way. It depends on how you use them. I think it's really important for you to use credit cards for a big purchase. If you want to buy a refrigerator, or you have to replace your air conditioning in your house, or you want to buy something kind of big item that you need to pay for over a couple different months. But if you borrow on your credit card for normal spending, like normal monthly spending, you're really just taking an advance on your future earnings. And that doesn't seem to be a real wise way to be able to kind of finance your life. This is an example of how long it might take you if you were to save $150,000 at $500 a month, it'd take you 300 months, 25 years to be able to save that much money to buy a house. But if you only have to save 20% of that amount, which would be a nice down payment, that's $30,000. So you could do that within 5 years. So it shows you the power of the ability to borrow money and why you might want to do it. Use somebody else's money to make a big purchase. We talked a little bit about this, credit cards. It's good to have them. It allows you to buy them. Having that cushion in your earnings so that you have credit available to you is important. It can get you through a tough time. You have your car breaks down and you have to fix it and it's a $1,200 bill. Then I think it's important for you to be able to use that credit card to kind of get over that hump, so maybe you don't have to have all those savings. You can use somebody else's money during that. Debit versus credit. So a debit card, the money directly comes out of your checking account as soon as you swipe the card. A credit card is, people have extended you credit. So your product or service is paid for now, but you have to pay back the credit card company at the end of the month. So your credit history is important. It's one of the few things that we have in our ability to assess your willingness and ability to pay us back when we extend you credit. So your credit report is important to make sure that you pay things timely, and we're going to get into some of that in a few minutes. But you can get one free credit report every year so you can see where you are. And it's not freecreditreport.com. So it says it's free, but it's not. So you need to use annualcreditreport.com is where you can get your free annual credit report. So everybody's heard about a FICO score, and this was developed by the credit card agencies to be able to help banks understand the risk of default. So when you look at the ranges here, the percentage of population that fall into those ranges, I would say anything from 650 up is a good credit score. So a good portion of the population is in that range. But it really is just our way statistically of finding a way to make sure that you have the best chance to pay us back. So what makes up your score? So amounts owed and payment history are the biggest portions. You can see that. So, one of the things that's important is if you have $1,000 limit, if you've borrowed more than $300 on that credit card, it starts to ding your credit score. So try and keep your amount available on your credit card to less than 30%. Over that, it doesn't give you that cushion that lenders want you to have. Length of credit history is also important, so that if you have a credit card that you've had for a long time, if you go to close a credit card, think about closing the credit card that you've had for the least amount of time and keep the one that you've had for the longest amount of time. That will also help your credit score. But payment history is the most important part. Pay things on time. So how does a credit score work? So it's your last payment. It starts up here in the top left, kind of goes around. Your outstanding debts, your history, your recent activity, and your credit categories. So sometimes if you are out there and looking to open new credit or credit inquiries, that will hurt your score because they think you might be in trouble and are trying to find a way to borrow money. So that's an early indicator of challenges. So I think that's one of the things why some of these inquiries do kind of hurt your score. So be careful about who you allow to pull your credit, because it might affect your score. What's a good score? So I said anything over 650 is good. So this is just happens to be there. The average score is 687. And I'll show you, the next chart will show you a little bit why this is the case. So these are scores rated to delinquency. So if you have a 350 to 499 score, 87% of those outstanding credits with people with that scores are delinquent on their payments. So you can see that, once you get down into the 650 and up, the numbers go way down into this status of delinquency. So one of the things here is, interest rate adjustments for FICO score. So when you look at eligible mortgages, they do increase the amount of the rate that you pay based on the base rate that they've decided for a regular mortgage with a person with a good score, greater than 740, doesn't really have to pay more for their mortgage. So this kind of shows you that the lower your credit score, they're going to increase your rate for the risk associated with a lower credit score. So that's why it's important to have a better credit score. Let you take that in a little bit. So we're using this to evaluate risk. So banks really look at trying to mitigate the risks associated with lending. So we're always looking at whether we want to either lend the money at all or what rate we should charge to get a decent return on the rent for that money. So we're looking at risk versus return. So we're trying to take a very little risk as we can. Banks only really get to make a 1% return on our money. So we really aren't in a position to take a whole lot of risk because we just don't get a whole big return. A person's credit score does not always reflect the situation, but it's the only thing that we have to go on sometimes. So knowing people at the bank and them understanding your background and understanding what happened, what may have happened that might have negatively impacted your score might be a way to be able to mitigate a lower score, but it's something that's important, and not everybody has a chance to know somebody at the bank. Length of employment, rent versus buy, credit history, all of those things we use to determine whether we want to make a loan or not. So this is an example of how a good credit score kind of translates to a better deal for a person. So if you had a credit score of 740 and you wanted to borrow 80% on a house for 30 years, you'd pay $4.25. And your monthly payment would be $737 a month. And basically, if you had a 620 score, you'd pay 50 basis points more or 0.5% more. And that results in you paying about $50 more a month or $44 more a month. And that's a total of $16,000 over the life of the loan that you would pay more for having a lower credit score. So it really does translate into something that's important for you guys to pay attention to. Rent or buy. So this is a good example of how if you were to rent an average 3-bedroom, 2-bath house in Metairie, it would cost you about $1,100 a month. But if you spent that same $1,055 per month, you could afford a home. You could afford a loan of $171,000. So it's interesting to say, you could actually afford a pretty nice house and get something kind of probably much nicer than you're able to rent. So that's why I think having good credit and saving up and having a nice down payment would be important for you. You'd be able to build equity in a house and have the money that you're paying benefit yourself, not someone else. Of course, there's really good reasons to rent. You know, if you want to move around a little bit, or you're not exactly sure you want to live there forever or for a long period of time, then I think it's important for you to maybe think about renting. And here's a car example of how you got, if you better credit score results in a better rate. So if you bought a $22,000 car, put $3,000 down, and you had a good credit score, you'd be paying $419 a month. But if you didn't have as good a credit score and you had to pay 7%, you'd pay about $35 more a month. So I think that's a good example as to why you wouldn't, you'd want to make sure you try and maintain your credit score as good as possible. And that's it for my presentation. I kind of blew through it. So I don't know if you guys want me to go back. I'd be glad to cover any other slides or answer any questions. Let's see. Looks like we got a couple.
Yeah, if you want to look in the comments box, I can read them out to you, or if you're happy, you can just check them out yourself.
I'm trying to pull them down so I can see them. So participants.
So the first question is, what are the quickest ways to increase your credit score?
I think you have to know kind of where your credit score is now and what is kind of holding it down. So if we go back to, let's see here. Sorry, going slow. So if we go back to this slide here, you guys can look at kind of what amounts are owed. So sometimes paying down your debts and getting more availability in that area can be important. You know, you can't fix the payment history as quickly because it really looks at the last 2 years. So you might have to have just time of paying things timely to be able to get to that. And then the mix between your credit cards, whether they be credit cards or installment loans, is another area where you can improve it. So generally, the easiest way to improve your credit score is to pay down or pay off some of your credit cards, but leave the availability there. So don't close the accounts, pay them down and leave them at a very low balance to the amount that you're owed.
I got a question from me. So if I have multiple credit cards and I have no balance on most of them, but I have one credit card that has a pretty high balance, are they going to measure my overall limit, adding all the credit card limits together, or are they going to still penalize me for having one card that's pretty heavily used?
Yeah, my advice there would be to spread it out a little bit and create more availability there. But they do look at your overall credit availability and where you are. I mean, it might be that that card has the lowest interest rate, so that might be important for you to be able to kind of, you know, maximize the amount of interest that you pay or minimize the amount of interest that you pay. Yeah.
Okay, thank you.
Sure.
Does anyone else have any audio or written questions? Yeah, there's another one.
What if there's something inaccurate? You can write the credit report and dispute something on the credit bureau and be able to get that fixed. So you can work with the different credit bureaus to do that. So the three main credit bureaus are TransUnion. Now I'm drawing a blank.
Equifax.
Equifax. Yeah. I only can't remember things if I want to remember them. Experian, yes. Thank you, Tammy.
Are there any other written questions or oral questions for John?
We went way too fast, didn't we?
We breezed through it, and yeah, if anyone has
You
any
want to go
questions.
back and see a slide? We'd be glad to show it to you. I think one of the things that's kind of interesting to me is that, you know, the pretty good credit scores, most of the population is in that area. So
What
you can
you
see.
what would you recommend if you have a low credit score and you're trying to get a credit card? Are there specific kinds of card that you would recommend? That
A
are
great,
available.
yeah, a great way to start is a secured credit card. So you actually put up $500, $1,000 and give it to the credit card company or the bank, and they'll hold it as collateral. And so you're really borrowing your own money, but it's able to show that you can generate that payment history with that card. So it's a great way to start. Um, Having someone co-sign for you is another way to do it. So a family member might co-sign for you, but remember, you might hurt their credit if you are not, judicious with the money and take care of it there. So I think you'd hate to hurt somebody that you care for when they go to put their credit up at stake for you.
Are there any other things you can co-sign on that are a safe way to build credit?
Car loans are really a good way because that's an installment loan. So you just keep paying it timely. It also helps you with transportation to make sure that you kind of have a job and keep a job. So those are always important ways to be able to build credit. A lot of apartment complexes and other landlords will check your credit when you go to move in. And so I think it's important there to have at least some level of credit. These credit cards that they send you while you're in school, you just have to be really careful with them and make sure that you don't abuse the rules, and kind of make sure you pay everything on time and don't kind of use them for, regular expenses. We want to use them for some extraordinary expenses. Now, I know some people, they like the points that come with credit cards. So they will spend everything they have in a month on like their groceries and all those kind of things, but they make sure that they pay all of it at the end of the month. So they kind of use somebody else's money for 28 days rather than using your money. So it's a good use, and you don't really pay interest on it if that's the case. So, credit cards can be really helpful in that you get points for spending the money with them, and then you don't really have to be charged interest. So you're using somebody else's money.
Thanks. I think the question from Tammy.
Oh yeah, I know there are different FICO scores. Which should we use for a mortgage? Actually, mortgage companies pull all three. And then you do some type of blended average between the three. They calculate their FICO scores a little bit differently. So it's not like they're all going to be exactly the same number. They all have their little black box that they put their algorithm through and kind of figure out where it is. But I will tell you that the ranges, they're usually fairly tight within a range between the three scores. So mortgage companies use kind of an average of the three.
There's another follow-up question, I think.
FICO 8, FICO 9, et cetera. Yeah. So, I'm a commercial lender, so I don't really do mortgage lending. So I don't know exactly how it is, but I think those are just used for a little bit different purpose, a little bit different algorithm and how they calculate certain things. So the ranges and what's a good score might be a little bit different between a FICO 8 and a FICO 9. They're always trying to evolve how they calculate things.
Going back to your slide about the annual credit report, I'm guessing you can only pull that up once a year, as far as I understand.
Yes, here it is right here.
And there is no score as such. They don't give you a number, but it's a very detailed analysis, or I guess kind of picture of all of your different lines of credit, right?
Right. So that was a great way to find out if it is correct. A lot of people have their identity stolen. That's exactly how to find out if someone else has taken out some credit for you. A lot of people can put these credit monitoring systems are pretty good. So if somebody goes to pull your credit, they'll notify you, so you know whether you actually ask them to pull your credit or not. So it does kind of give you a early warning if your identity has been sold. So Brandon's asking a question about Credit Karma or other similar websites. I don't really know that much about those websites. I think they are probably well-meaning, but and I think a lot of people do have some challenges with their credit. And if you do have challenges with your credit, you're really looking for help to figure out how to do it. I don't know that I would rely on someone I don't really know or don't know if I can trust them or not to be able to help me with that. There's all these people who are saying they can help you with your credit, and I'm not so and especially if they want money up front to do it, I'd be very suspicious of that. Because I think a lot of them take your money and don't necessarily follow through and help you towards the end. I'm not saying it's Credit Karma that does that or not. I don't really know, but I would be very suspicious of anybody who wants the money up front. I think it should be pay for performance.
Thank you. I think you touched on this earlier, but would you be able to kind of talk in more detail about a hard and a soft inquiry on your credit and how they affect it?
Yeah, sure. So a soft pull would be something that like the bank might do that once a year on all of our customers, just to kind of see where they are, to make sure if their credit has deteriorated since we made them a loan. So we do that, but it doesn't count as a true inquiry. So a hard pull is something that a mortgage company might do or that kind of thing. Let's see here. My parents have a lot of credit card debt from miscellaneous things, especially car debt from the car dealership. If I want to make sure they're not being taken advantage of, what questions can I ask them? I think getting an annual credit report pulled on them and looking at what it is. When you say especially car debt from the car dealership, so they've borrowed money on their credit card. Is that because they traded in a car and it didn't pay off the loan fully, so they had like overhang on the loan? Okay. Yeah, that's tough. It's important to be able to kind of make sure you don't borrow so much on a car that when you go to trade it in, you're not what I'm going to call upside down on the car. The car's not worth as much as you owe on it. That's a real big challenge. So that's why making sure that you put something down on the car. You don't just walk in and borrow every dollar that you can on the car without putting anything down to try and get that in. So building in that equity in the loan, that's what that's called, is that, your kind of ownership amount that you owe on a car versus what a car's worth, that the difference would be called equity. And having equity in your car or in your house or anything else is important because the valuations do fluctuate on vehicles and homes. So you want to make sure that you're not upside down when you're borrowing money. I think that to answer the question on how to get out of that situation is you really just have to pay that debt off as quickly as you can. Save your money and plunk it down on the credit card as fast as you can and pay that down as fast as you can. It's really the only way to not get taken advantage of, especially from an interest rate perspective. Credit card interest rates could run 18% or more, 21%. So that's a very high interest rate.
Would you ever recommend consolidation loans, so where you're able to consolidate your credit card debt and pay it off with a loan?
I think that is a good strategy, but the deal is you can't go and borrow the money on the credit card again. Don't create that availability by paying the credit card down and then go borrow it back again. You're trapping yourself in that you're going to have both payments again to be able to make. So yeah, a consolidation loan is a good tactic to be able to kind of get out of that situation, but you have to be financially disciplined if you're going to do that. Let's see, Maribel is asking, what's the average interest rate for a house right now? I would say you can borrow money on a house Anywhere between 3.5 and 4.5%. That's kind of a good range. That's very cheap in relative times. Interest rates are very low right now.
What's the average amount that people need to be putting down for a property at the moment?
Well, it depends on the type of loan. You can probably get away with as little as 3% in a FHA or VA loan. But the more traditional loans, you should probably put 10 to 20% down. If you don't have at least 20% equity in a house, you're going to pay something that's called PMI, private mortgage insurance. And that's basically like default insurance. So, and that adds probably a couple $100, maybe $400 or $500 a month to your payment. And that's an expensive way. It's an expensive way to not put money down. If you think about the trade-off between saving the money and putting it down versus paying $400 a month for 30 years, or such time as you get down to 80% loan to value. So, I actually had a friend of mine the other day call me and ask me what he thought I should do. And I told him, I was like, call the mortgage company and find out how much he would have to pay to get out of private mortgage insurance. And I figured out that it was only about $6,000. And so he had the money. So I said, you should just write a check to him for $6,000 and you'll save yourself $400 a month. So the payback on that is pretty quick.
And can you do that at any point in the loan, or do you have to do that right at the beginning when you're putting a down payment?
He didn't have the cash when he made the loan. He did have the cash maybe about 6-8 months later. And I'd be nice. I'd like to call him back and find out what happened on that to see if the mortgage company allowed him to do that, which I think they would. They want to have the equity in the house. Thanks.
Are there any more written or verbal questions for John? I think that's it for today. So yeah, thank you very much, John. I appreciate your time, and thanks for the questions. We have our last webinar of this series on Thursday at 4 p.m. Doing Budgeting 101. It'll be Tracy Texter from Home Bank again, who'll be running it. And she did a great session the other week on home ownership. So please feel free to reach out.
This presentation's on your website, right?
It is, yeah. Yeah, I put it in the comment section at the very top. So if you click that link, all of the previous webinars with the PDF and the recording from the session will be on there. This one will be on within 24 hours. And there's a lot of information on our Facebook as well about it. Yeah. Upcoming things that we're running. So.
Hold on one second. I'm going to go to the last page and that people can get my information.
Yeah, leave your contact details up for a little bit just in case anyone wants to reach out to you directly.
There you go.
There you go. So yeah, if you want to reach out to John directly and you have something that you don't want to kind of discuss online, please feel free to speak to John, and my details are on our website. So thanks everybody for joining. Hopefully I'll see you on Thursday for the budgeting session. So, take care, everybody. Thanks.
Bye, guys.